Boss, we are not in the business of losing money. We are going to make XXX profit this year. Don't try and overcomplicate the thesis. Don't try and over ask questions to the point where you have confused yourself as an investor about what to do.
Very curious that what was your mental framework in selecting these kind of founders?
Ability to generate unit economics. This is something that we've learned the hard way. Being successful at anything requires tremendous amount of focus, discipline, excellence, work ethic. People say, crisis creates character. It actually doesn't create, it reveals.
Hi, I'm Sandeep Jethwani, the co-founder of Deserve and the host of the Create Wealth podcast. Today, I have with me Kunal Bahl, who's the co-founder of Snapdeal and of Titan Capital. In this podcast, we talk about his investing journey of backing really successful startups. What is his framework of selecting these founders to back? How should founders pitch to investors and how should they engage with their board subsequently? And finally, we talk about a very personal area, which is his co-founder journey with Rohit Bansal. I hope you'll enjoy this one. Kunal, one of the things that I've noticed very recently when the Mamaearth listing happened is newspapers and media articles about how much return on capital you and Rohit had on that particular investment. At least on the face of it was over 100 times. And when I thought about it, there are some consistent investments that you guys have been very successful at. Whether it was Mamaearth, as we said, or OfBusiness or Ola in the past. I'm very curious that what was your mental framework in selecting these kind of founders? Because when they would have come to you, it would probably have been just a paper plan at that stage. So just talk to me about that.
Yeah, I feel that first and foremost, it's all the founder's effort that creates these companies. Investor mental models are interesting to analyze in hindsight, but honestly, none of that is particularly pertinent if we don't appreciate the amount of effort and the founders have put in, because they have created the company. We just put in the money.
That's right.
Right. So literally 100% of the credit is theirs, not 99. 100% of the credit. Because had we not invested, someone else would have invested, and the company would yet have gotten built. That said, at the earliest stages, our goal first and foremost is to just support the founder, right? Help founders who we feel have the capability to build large businesses. One, the quality of the team. Have they demonstrated any amount of success in anything they've done in life?
So right? Not necessarily in the space that they are in, but in anything.
They're innovators, right?
Yeah.
So chances are, if they're innovating, they've not done this before.
Right.
They may likely don't have any context to what they're building today. And so it could be, obviously oftentimes people point to academics, but more than academics also. It could be if they worked at a startup or worked at a company, did they create an impact there which is meaningful? Maybe they were a sports person, maybe they were a dancer, maybe they were a singer. Because being successful at anything requires tremendous amount of focus, discipline, excellence, work ethic, all the attributes which are incredibly critical as you build a business. So that's one. Secondly, ability to generate unit economics. Now, this is something that we've learned the hard way as founders of a company in a highly competitive industry, where it is so hard to have positive unit economics. But many times you're surprised where founders are not putting enough thought into it. But many do. So what we want to see early on always is the ability to generate unit economics. The company may not be profitable at a whole for the first few months or quarters. Unit economics have to be positive literally from day one. The concept of, oftentimes we'll hear from founders that, hey, as my business scales up, my unit economics will improve, my margins will improve. I'll go from a 10% gross margin business to a 50% gross margin business. It never happens. Sometimes founders will be very pushy. They'll say, no, it will happen. And here's the reason. We tell them that, look, it can happen because of your force of character, but it will not be in the same business. You will likely have pivoted into something else, and which will be a 50% gross margin business.
Sure.
But a 10% gross margin business may become a 15-20% gross margin business. It never becomes a 50% gross margin business with scale. You have to do something structurally different. And that's something we generally stay away from. What we like is that the margin, the shape of the P&L should be reasonably well defined in the early days. Doesn't need to have heft, doesn't need to have large numbers yet of revenue or margins, etc. But it needs to have shape.
Some of these companies are probably not even founded or incorporated when the founder is coming to you.
Yeah.
So at that point, when you're looking at the unit economics, is it a sort of a projection that the founder is showing you, or do you try and understand that particular industry and then say?
Actually, Sandeep, while we look at companies even before they're incorporated, they're not even companies, they're just individuals. But what we've seen over a period of time is there has been a lot of evolution in the ecosystem.
Sure.
Where now founders themselves are coming out to the market to raise money once they have proven to themselves that this company has the ability to generate unit economics.
Sure.
Or maybe there's a self-selection of the type of founders who come to us because they've heard from other founders in the ecosystem that these guys are good investors, but they are really, really picky about unit economics. So invariably, 8 out of 10 companies we'll meet, they will have a clear demonstration of where the unit economics stand as of today.
Got it.
Now, there are obviously some types of businesses where you usually don't have to worry too much about it, like pure software businesses, where typically the margins are so high, like 80-90% margins, where it's more a question of does anyone need this, or how will you go to market with it, or what's the competitive landscape? Are other people selling the same software or not? Which are the more cogent questions than the ability to generate unit economics.
Got it.
That generally applies to commerce-oriented businesses or payment-oriented businesses where money is moving from point A to point B in some shape or form.
Interesting. So let's take one of your very successful investments, say in OfBusiness, where you had backed Ashish and Ruchi in their journey. Now, how did that investment happen? Because I think there is an element of access, like you said, that some founders can raise capital at that stage from practically everybody, right? So how did that introduction stroke network happen? And then how did you evaluate these 3 parameters for that business?
Yeah, I feel that when you take a lot of shots in life, you deserve to be a little lucky. And I think OfBusiness was definitely one of those where coincidentally, one of our former colleagues, Bhuvan, who used to be a senior leader in our engineering team, had joined OfBusiness as a co-founder, or joined Ashish as a co-founder to start, and Ruchi.
And he heads the engineering piece, right?
Right now.
Yeah.
And so that's how the introduction was precipitated. And literally, I think there was really no business at that point in time. This now predates many years. We're talking 2015, I think. And I met Ashish, and I could tell this he's literally a superhuman. He's really a force of nature at some level. But it was very early days. The business was very different from what it is today. It was more in the realm of B2B for hospital supplies, if I remember correctly, in the early days. And obviously now the business's scope and width has expanded so materially, and scale, obviously.
Yeah.
But Ashish, whenever we've had a conversation with him, he was always very, very clear about that my business is here to generate a profit. I'm not in the valuation game. I'm not in the fundraising game. That's a raw material for my business. But everything he would always say is, I need to generate a profit. I remember one time in 2017, some gap had come between our last meeting with him, and we'd asked Ashish, how are the financials? How much money are you losing? Right? He had a very brisk and direct response saying, "Boss, we are not in the business of losing money. We are going to make XXX profit this year." Right? And love that. Right? We love that as fellow founders. We love that as obviously early investors in the business. There's just absolute clarity of thought that I'm here to build a lasting, enduring business that generates profit from the earliest days possible.
Sure.
But look, this framework we've applied in so many different cases. Let's take Urban Company, for instance, where I remember we had met Abhiraj, Varun, and Raghav very early when they were still in the phase of deciding whether to do what is known as Urban Company or put screens at the back of seats of intercity buses. right,
okay.
for entertainment. That's
Interesting.
how, when the introduction was made to us through a common friend, that was what they were deciding on. Eventually, obviously, they decided to do the marketplace for services. And obviously, we were also a little more keen on them doing this business. We would have backed them irrespective.
Sure.
But we were keen on this, partly because we were building a marketplace of products. And we said, why should there not be a marketplace for services? Because how our business started was a marketplace for restaurants, bars, salons, right, coupons, etc. But for these other types of home services, you need a marketplace also. And there was none in India at that point in time. But even in the team, absolutely stellar. I would rate them as one of the best teams in the startup ecosystem. The level of intellectual and operational rigor that they bring, both at the same time, in an incredibly hard business, is unmatched. And it's an inspiration for an operator like me also. So the team was really checked off, right? In terms of TAM, it was very clear they were going to go case by case, like use case by use case, right? Segment by segment. They're doing beauty, they're doing
ACs and
various appliances, etc., etc. One by one, they're going into a segment. So they're very, like, seemingly laughably small TAMs, right? Like where people may say, "Oh, how large a business can you really build by sending beauticians to someone's house?"
Correct.
I think they've shown that you can build a pretty large business. You just have to provide the right customer experience, right delight.
That's right.
And then finally, on unit economics, they've been very, very focused from the earliest days that we will price our product, our services attractively, but make sure that we juice out enough efficiency in our system that we are able to provide great quality of service at the right price, but while making positive unit economics. And they follow that discipline all the way through till present date. So that's a good example of the trajectory being set right of the company from the get-go. Obviously, they've made mini pivots and changes that, like, all founders and businesses have to do. But largely, the principles have stayed constant.
No, I agree, because that's what they say. If you're flying from London to New York and you change your trajectory by 2 or 3 degrees, you'll end up in SF, right? So I think that's one of the important things. Now, Kunal, talk to me about, like, some of the anti-portfolio situations. Now, anti-portfolio is where you've seen a great company, for whatever reason you did not invest, and later you realize that, oh, look, it became a very large business. Did you have those kind of events at some point in time?
I'm sure there have been many, Sandeep. Many. It's hard to remember all of them now, but actually it's also not about, you'll meet all these really, really smart founders, right? I feel at the core, I'm a founder, right? I don't think of myself as an investor, right? I think of myself
and
as
we'll talk in a bit about that.
Founder, entrepreneur, operator, not an investor. But being an investor, I feel for all investors, they must see it as a privilege that you get to meet such really, really smart people all the time. And it's so easy for me to fall in love with all of them, right? But you can't obviously support all of them. You can't invest in all of them. But many times you'll meet some founders where you wish you had invested in them, right? Even if the business did not make sense to you at that point in time, you wish that these are people that you can have a lasting, enduring relationship with. So there are many such people that we met. See, businesses themselves go through their twists and turns. So it's hard to comment on a particular business, but there are so many fantastic people, so many fantastic founders out there.
And to that point, Kunal, you've been on both sides of the table. You've fundraised yourself and you've invested in startups, right? And how do you therefore think about today a conversation which is quote unquote a pitch, where a founder is talking to an investor to raise capital? What are some of the things that a founder should think about going into these conversations? And I suspect, like, founders have gotten better at communication over time.
One would argue sometimes too good
at pitching. But for those of us who are not, what are the things that they should keep in mind? How should they structure that conversation?
It's a very good question. And I think you kind of had an answer in the question, that it's very important to approach it like a conversation versus a pitch, right? Yeah, you need slides for a structure, etc. But all good investors I know, at least at Titan Capital, this is a tenet we have. All the materials that are sent, not only by the company, but some pre-read materials, prep materials our team prepares. We all read everything and come to a meeting. We're not seeing the presentation for the first time ever.
That's right.
Because that's the minimum courtesy an investor can extend to a founder who's juggling 1,000 balls. And if you can't even study the materials that have been pre-sent in advance of the call,
which means the founder needs to pre-send a material, right? A pre-read to the investor.
Yeah, I mean, that goes without saying.
Sure.
Absolutely.
Yeah.
What we like is like very, very brief materials. Like if you have something of value, you can probably say it in, two pages. Some founders just send us 2 pages. They send us a Notion document link, or they send us 5 slides. Generally, the scary ones are the 40-slide presentations for a seed stage company.
Yeah.
There you feel that you're explaining too much, and in some ways, if you're explaining too much, you're already losing.
Yeah.
Right.
Yeah.
You shouldn't need to explain this much.
Yeah.
If the problem statement is fairly simple. Any company, most companies that we look to invest in Titan, I always go and have a conversation with my 7-year-old daughter about it. Right? Like I give an example about the pots and pans companies.
Yeah.
I had a conversation with her about that company. I told her, look, we're looking to invest in this company. I showed her the photos. The company is called Petal. And she said, but why do we need more pots and pans? Right? Very good question.
Yeah,
we already have,
right?
Enough to cook food for the family. I said, well, it's healthier. Right? She said, well, if it's healthier, does it cost more money?
Yeah.
Like, yes, it costs more money.
Yeah.
Right? And so on and so forth. So these are very simple brain questions that literally a 7-year-old knows how to ask. So at least we also approach it the same way.
Yeah.
Don't try and overcomplicate the thesis. Don't try and over ask questions to the point where you have confused yourself as an investor about what to do. Like, just know what are the few things you want to hear. Most good founders realize that at the early stages. Also, now the tribal knowledge, Sandeep, is so rich amongst founders about how to create your materials, how to pitch to whom, at which firm also. I'm sure there are like documents floating around about which investor likes which type of company, etc., and what type of materials they should be presented.
Maybe there's a Reddit page somewhere about this.
I'm pretty certain there is, or at least there's something floating around. But it's good. It's an indication of the evolution and maturity of the startup ecosystem that founders are getting past the real, sort of rudimentary errors when it comes to fundraising. They are well prepared. Their materials are generally sharp. They talk about the important things that matter, which is team, the space, what is the 10x experience or 10x intervention or 10x wedge they have found in the market. How do their offering compare? How does their offering compare to other market players if they exist? How will they monetize? Right? And then obviously, what are they looking to raise and why?
Sure.
It's really as simple as that. It's 5-7 slides. Like it shouldn't really. By the way, this applies to business probably of any scale.
Sure.
It's funny, right? Like the number of slides a company uses to explain its business generally tends to reduce with success.
Absolutely.
Right?
Because so large public companies do 2-3 slide decks for their quarterly presentations.
Yeah, that's it. Because if the business model is set in its ways, only thing you have to show is performance.
Sure.
Right? You're not changing the business model frequently. So we like founders when they are concise, they're crisp, they have already pre-thought of all the key questions and key concerns investors will have. They've pre-addressed it and they're not trying to skirt it. All these things build confidence and credibility in a prospective investor's mind that this is an entrepreneur or set of entrepreneurs who have already thought through all the blind spots. Because as an investor, as an early stage investor, you will not be able to become an expert at everything.
Yeah.
But you want to look a founder in the eye and assess and feel it in your bones that this is a person who's thought through 3-4 levels more than I can think through today. right?
So actually, what I'm taking away, Kunal, from this is first the fact that you need to have a concise pre-read, which sort of forces the founder and the team to put everything down in a way that's simple enough and yet explains the business problem. The second is to be able to do some work on the investor and how the conversation will likely go, and call out the ask very clearly.
Yeah.
When you're making these investments, is there some bit of signaling also that if Kunal has invested, then probably on the back of that others will invest, or do you invest on the back of somebody else also making an investment?
We generally form our own convictions, Sandeep. Like there are many times we are the only investor or only institutional investor in the round. We are happy if we like a company, like a team, like a space. We are happy to be the only money in the company also. We have no problem whatsoever. We're not looking to borrow conviction. We rarely participate in later. Our first entry point is almost never in later rounds of companies where they're raising large institutional rounds. Because we are known to be fairly valuation sensitive, because we come in very early. We are taking maximum risk, and hence it's okay to be a bit conscious around valuation. And that doesn't mean there's anything wrong with the company or the founders or the space. It just doesn't work for the segment we look at in terms of investments. But what happens is, as you're seen to be more successful as an investor, a lot of people start seeing that as a cue, as a stamp of validation that maybe these guys have a rigor, a methodology, or pattern recognition from experience, good and bad experiences of what may work, what will not work. But to be honest, like, we also don't know. Right? We are, any investor, including us, we're only as good as our last investments that worked. We could have 3 years of bad investments, and then people will say, well, they lost their touch now.
Interesting. And Kunal, like, now from a founder's perspective, there are two sets of folks as when we also interact from our investing perspective. One is a set of folks who have all the access today. They speak the language, they're connected with investors. And in their case, they're sort of figuring out which investor to go after, right? Now, for that cohort of people, how should they choose the investors that they should pitch to, the totem pole of priority in terms of who to go to first and who later to go to?
I think irrespective of what I say right now, the approach will not change, which is a complete machine gun. Which I think, which is okay. That's what we did in our early days. There were 13 VCs. We machine gunned all of them with our pitch deck, either cold calls or through introductions. In the end, the question to ask is, that any founder should ask, is like, what are the attributes I should look for in an investor, right? I feel the attributes one should look for is the person investing in my company because of the micros of my business, not the macros of my business.
Okay.
Right. So what that means is, they like me in terms of my ability to build a business. They like my business idea, my thinking. They like my traction. Right. They like my competitive positioning versus other market players. As compared to, they like the industry, and now they're like, whoever is willing to take my money, let me give him money.
Sure.
Him or her money. So,
and why is that important? Why is the fact that the investor should understand the micro important?
Because even in tough spaces, smart founders end up building good businesses. But in really good spaces, if you haven't studied the micro and are not convinced of the micro, or the micro has challenges, even in good spaces, the company will not do well.
Got it.
So we are not at all trend spotters, trend watchers, wave riders. Like, we are none of those. We are always focused on the micro of a business. So there are times when we have not invested in waves, and people have asked us, you completely missed it, it seems. We are totally okay with it. Over a period of time, what we realized is that why we didn't like the micro of any business in that wave or in that sector was because the micros didn't make sense. Just the wave made sense to everyone.
Sure.
And waves, the thing with waves though, Sandeep, is they come and go.
Yeah.
But the micros, if they are strong,
Yeah.
then over a period of time that builds strong foundations and lasting, enduring businesses.
And to give examples, like in the last 2-3 years, I would suspect right now we are going through this AI wave where AI startups are getting funded. A couple of years back, we had this crypto wave that crypto startups and blockchain startups were getting funded. And the question, I think what you're really saying is, why do you like a particular team, founder, business, as opposed to generally saying that I need to make one bet in the AI space?
Those usually don't work out. I've rarely seen those work out. Right? We are not, and we don't need to be in all the good companies. Right? We just need to make sure our companies are good.
Yeah,
that's it.
It's a good way of putting it.
That's to have a good outcome as an investor. You don't need to be in all the companies. Actually, not feeling FOMO is a superpower. Particularly in early stage.
Yeah. In any investing,
investing probably, but in early stage, I think it's even more so because you feel that you had access to this company that could deliver the 100x return and you missed it.
Yeah.
Right.
And if you don't invest, then you probably can't get in ever again.
Correct.
Yeah.
But I feel over a period of time, shaped by our own experiences, now we feel no FOMO. If it doesn't make sense to us, but it makes sense to the rest of the world, we wish the founder the very best, right? And we want the best for them. It just, at that point in time, we just didn't understand it, but that's okay. We may be wrong also. We are often wrong, actually. But we are okay with that also. We just need to be right in the ones that we've actually invested in. That's all that matters.
Once we've made an investment, Kunal, into a startup, and now the business is sort of getting off the ground, what should be an investor's expectation from a founder? Or flipping that, what should a founder do in terms of communication, engagement with the investor? What is the frequency? What are the kind of materials need to be shared periodically? How much consultation on the business direction should the founder make with the investor or not? And this, I want you to sort of weave in your own experience of Snapdeal as well.
Yeah, I feel that if there is one, people ask us, hey, what are the patterns you've seen? There's so many companies you're involved in that have done so well across sectors, whether it's fintech or whether it's consumer brands or e-commerce or whatever. Why? What is the common pattern? Obviously, it's the quality of team, economics, and how they've approached creating customer delight. But what, in terms of governance of the business, one of the key things that is a common pattern between each of the companies that has worked is the rigor around a monthly MIS that the team prepares and also sends to all the investors. There is no company that has worked out really well that we have seen where that rigor was not there. Doesn't mean if you have that rigor, that's enough.
Yeah.
It's necessary but not sufficient.
Sure.
But it is necessary. Right? And founders feel that it is for the investor, actually it's for themselves.
Sure.
It's for themselves to have a clear lens and clear view into how the business is trending month on month, and then cascading it down to the rest of their team that here's how we are doing. Looking at this mirror on a regular basis, like even in all our businesses, whether it's Snapdeal, Unicommerce, like in our businesses, we have weekly management meetings where we discuss the projected financial results for the month, and we track that against plan, and we discuss interventions that are needed in some places which are tracking below plan. So for us, it is an absolute requirement. So we have a list of what we call closely watched companies, about 30 companies at any point in time, where Rohit and I will spend a good amount of time with them. We'll meet them maybe 4 times, 6 times, sometimes 12 times a year for really young companies if they need it. Where we will discuss the monthly MIS. We'll go through the details with them. We'll ask them what their roadblocks are, where the challenges are. We find it really intellectually enriching also. But at the same time, founders tell us they find it very helpful because in hindsight, Sandeep, we've seen it's the same pattern of mistakes that we made in our early days and founders have continued to make, which is doing too many things, not having focus, having this portfolio approach to the business very early on. Also.
So you're hedging your bets too soon.
Yeah, you have to have conviction. This is it. This is what I'm going to do. Focus issues, overspending, like hiring too fast, spending too much money on marketing or other business development activities too early before the product has demonstrated strong product market fit, not focusing enough on the unit economics of the business, making sure that they stay in a healthy zone, even if the company is not making money yet, having a clear glide path view of how do we get to profitability from here. Like those type of things seems very basic, but we do empathize with founders that at the early stages, they are juggling, as I said, 1,000 balls. Some of the really critical stuff sometimes gets diluted. But the tricky thing is in early stage companies when there are 5 employees, 10 employees, 20 employees, if the founder's not thinking about some of these critical things, nobody else is. Things will just keep drifting.
Correct.
Right. And then they'll drift to a point of no return, unfortunately.
Right.
But we are those, buoys, like we are the guardrails in some ways to making sure that, hey, on a monthly basis, let's make sure that nothing that is detrimental to the, mortality, nothing that creates mortality for the business gets introduced. So we have enough time to build what we need to build.
Help me understand, Kunal, what does this MIS look like? Like for let's say a early stage founder watching this today, what would be the key components of the MIS? I'm assuming things like revenue, costs, etc. are there, but is there any other thing that you would be specifically focused on?
Everything flows from the P&L of the business. Like that is in the end, and in some businesses, some types of businesses, we also look at cash flows and balance sheet. Right now, this may seem like, was this a podcast for early stage investing or private equity? But, whatever it may be, whatever is needed in a business has to be tracked in a business. So if a business is a working capital intensive business, many of the brands businesses are working capital intensive, many B2B businesses are working capital. There, just by looking at the P&L, you're getting a partial picture of the business. If you don't understand how the working capital is playing out in that business, you can have a very healthy P&L and the business will still shut down.
Because you run out of cash.
So, and many companies have faced that issue, particularly in the brands and the B2B space. Or the other way around, everything is fantastic, you run out of cash to grow the business. That happens all the time. So
interesting.
The rigor around everything flows. Actually, it's like like we go for our preventive health checkups, right? There are a few markers that kind of tell you something's wrong. Then you double click and say, okay, let's look at a little more data and see what may be the reason why our gross margins are not growing or why they're declining.
Right. Like things like receivable days or how much time are you taking to collect the money back? Those are things that probably the MIS, depending on the business. Kunal, now let's say the company has scaled to a certain point. You also have that situation where you're dealing with a board as a mid-stage founder, right? You have institutional players potentially on the board. In some cases, some founders are also adding independent folks to the board. Not only have you dealt with a board, but you've also served on public boards, including Piramal. How should a founder go about that construct when it's creating a board or even otherwise creating a set of advisors around the business?
See, the difference between boards of venture funded companies and like larger public companies is that most of the board is constituted in the venture funded companies of investor directors. But in public listed companies, that's usually not the case. Most of the board is either executives / promoters and independents. Sometimes they'll have an investor director, but that's rare.
And in a way, the independent directors are representing the shareholders.
Right. So I feel founders don't really have much. It's a good question, but I don't think founders have much choice in terms of how the board is constituted. That said, at least my big learning about how do you get the most value out of your board? First and foremost, make sure that you have completely relinquished everything to do with governance tracking of the business to the board.
Explain that. What does governance tracking mean?
Like everything. Are your financials getting audited properly? Are they getting audited and filed at the right time? Are you doing internal audits? Are you doing secretarial audits? We do quarterly audits in our companies. Right? Like, so I've been immensely benefited by almost everything I know about business. I've learned from Mr. Akhil Gupta, who's vice chairman of Bharti. He's been on our board for 10 years. I actually knew nothing about business till I met him, which I realized later on how little I knew. I still don't know a lot, but I can attribute almost everything I know to him.
And what were the key interventions that he
Like, for
pushed
instance, like around governance particularly, right? Like doing quarterly audits, having secretarial audits done, having the right type of team in place in order to do all these governance actions, and just so that you sleep well at night. There are no surprises in your business that hit you at any point in time. The barometer is there should be no surprises for anyone, for you as a management, promoter, owner, founder, or independent director, investor director, or shareholders at large.
Yeah.
No surprises whatsoever. There can be all the companies go through their ups and downs. There are sometimes good tailwinds, sometimes there are headwinds in a business. People make peace with that. But there should be no surprises around, you said the number was X, but it turned out to be Y.
Yeah.
It can never be that.
Yeah.
Right. But I think to the point of how does the founder leverage the board effectively? One is obviously you make sure that, look, you guys are custodians of governance. We are just doing all the actions.
Sure.
Please probe us hard.
Yeah.
That are we doing everything right or not? And if you're not, please tell us and in good time so we can fix it. So at least that's the approach we've had.
Yeah.
Now, secondly, when it comes to more operational stuff like help with the business, one of the things I've realized is that typically every person who's usually on a board and is experienced, seasoned as an investor or an independent director or a seasoned professional has some superpower. And oftentimes I used to do this in my early days as a founder, that I would go to everyone for all kinds of topics.
Yeah.
I would ask I'll go with my list of 5 questions to every board director and ask them, here are my 5 questions, please give me your views. Funny thing is, everyone will give you 5 views, their views on all 5.
Yeah.
Even though they may, whether or not they have expertise on all 5, which nobody does.
Because you're asking them to step in and guide you.
They'll give it. They're doing it from, a goodness, place of goodness that and well-wishing that they have for you. Doesn't mean that they have the best advice on everything. So a founder has to figure out that which investor is going to be great at giving advice about transactions or fundraising or marketing or corporate managing the highest level of corporate governance or recruiting or engineering, etc. You have to decide as a founder. Doesn't mean that I'm not trying to say that those other directors don't know about these other topics. It's not their superpower.
Everyone is really good at one thing.
You identify what that one thing is and then mostly go to them for that. And then there is also continuity of conversation because that one topic you've been talking to that director for quarters and years, and they are also really invested in your success in that particular track, whether it is building a good engineering org. You've been talking to one director about recruiting, then you've been talking to them about, hey, here are the people I have, what do you think? Can you spend time with them a little bit? Can you guide me who else I should hire? How should I structure the team? Then they are also a little more in the detail versus only at surface level on 10 different things.
Got it. And therefore, these discussions probably are one-on-one as opposed to doing it only in a board meeting.
Yeah, absolutely. The way the board meeting should be run, how we run ours is we typically will email all the materials 7 days in advance to our board, and we solicit questions. That if you have questions, please send the questions across. And then if the questions come before the board meeting, we first discuss the questions. Right, and so that maximum time is given to the topics that people already have on their minds that they would like to discuss. And then rest of the time, our management teams, the CEO of Snapdeal, CEO of Unicommerce, etc., they will walk the directors through the key aspects, key developments in the business.
Kunal, we've spoken about the tangible stuff when it comes to a business, things like MIS, P&L, etc. Now, with every business comes the intangible stuff also, which probably as an investor, you get sense around things like culture, things like the kind of talent that the company has and so on. Are there some intangibles that you would also track when you're evaluating a business? And if you do, then how do you help shape that in a direction that's correct for the company?
Yeah, I feel that, at least at the time when we are looking to invest in companies, we don't get that much time to figure out a lot of the intangibles, because we meet founders maybe 3 times before we decide to invest. These are 3 1-hour-ish, 1.5-hour meetings, so total of 4 to 5 hours.
Yeah.
That's not enough time to figure out the intangibles, but people do show their colors in the process, right? So how prompt they are, how clear they are in their communication, how transparent they are about their insecurities. Are they a, bad faith negotiator or a good faith negotiator? Right? These are all the things, because for us, like, our word is our bond. Like, if we've said we're doing it, we're doing it.
Sure.
We have never, ever not done something we've said we will do. Right? But unfortunately, that feeling is not always reciprocated. Right? So that makes it, actually, the decision becomes easier for us.
Sure.
Because we feel that, hey, if we can't have this a trustworthy relationship today, things will only get harder later on.
Yeah.
So I think there are some gives like those that we are always watchful for. We like folks who are transparent, direct. You don't like something about what we said or are doing, please tell us, and we will rectify it or we'll talk about it. So I think we like that transparency of communication, because we also stand by the same thing. We're incredibly transparent in our communication. I think the other thing we do tend to talk to founders about is, see, they don't have large teams that you can go and talk to. Generally, it's 2 of them, 3 of them, and 1 or 2 interns usually. But how they have gone about hiring those people that they actually did get on board without any funding, without any stamp of validation from, let's say, a Titan Capital, tells a lot about them also. Their ability to build bonds with people, where people are willing to trust them with their careers, saying, I'll leave a job at Google and I'll come work with you even though you've not raised money. These are very strong tells about, is this someone who I can visualize one day will stand in front of 1,000 employees with a lot of charisma and be able to motivate them, particularly in tough times.
Interesting.
Right? Because it's in those times of crisis, people say, crisis creates character. It actually doesn't create, it reveals character. And so at least I try to put myself in their shoes or them in mine, because I've had to do that, right? Like, many times in front of 1,000 people, you have to speak and you have to motivate them, especially in tough times. And I try and see, can this person one day do that? Right? Because if we are backing them to build something really large and impactful, which means along the way, they'll have to cover a lot of these hurdles and grow as a person.
And are these qualities then innate, or can they be learned over time? Because when you said that some of this stuff is revealed and not developed over time, it almost feels like going in, if somebody is a founder or not a founder.
Actually, the journey that you go through, creates the character, but it's moments in time that reveal it.
Sure. Got it. And that brings me to the point about your own founder journey. And the way we look at it outside, and at least is, and having interacted with you and Rohit for some time, it almost seems like it's a very tightly knit bond between the two of you as co-founders. Things like even your investments are done together and are sort of mirror images of each other. How was that journey of your own along with Rohit? Like, how did that come together? But also, how did it evolve over time?
I would say, in addition to having a fantastic family, I think my relationship with Rohit is probably my life's greatest blessing. Right? And the circumstances in which we met was also so serendipitous, because Rohit grew up in a small town in Punjab till class 10th. Then he came to DPS, where I'd studied in DPS all my life. And I remember vividly on day 1 of class 11, when he joined DPS.
So he was 16, you were 16, 17 at that point.
16 years old. So he and I were sitting in diametrically opposite corners of the classroom. I was sitting front row, first column of seats in the front row. He was sitting last column of the seats in the last row. Right? And serendipitously, almost magically so, I would say, within 15 days, we were sitting next to each other. And Rohit was a hostler. I was a day boarder. The hostlers tend to stick to each other.
Sure.
Most of them in DPS in class 11 come from outside Delhi.
Yeah.
So they feel more comfortable hanging out with each other.
Yeah.
So just our backgrounds are different, right? Everything is so seemingly different, right? Like, but what are the chances we're just sitting next to each other? And I feel there was this gravitational pull. Like, then he and I went to different colleges to study. We stayed in touch, and literally at the first precipitation of an opportunity, when my H-1B visa was rejected and I was asked to leave the US, I came back, called up Rohit. He just, like, in a minute, there was no thought. Like, he was working at Capital One. It was one of the best jobs at IIT Delhi that one could get. In a minute, he said, "Yeah, let's start." So I think there is tremendous amount of mutual respect, mutual trust. We don't second guess each other. We do debate. We do disagree, because I feel that day is not good when we've stopped disagreeing, or we stopped having diverse perspectives. I think that diversity of perspectives actually helps to make better decisions in the end. And so he and I actually, we completely, we're completely in the zone that, look, you are good at something, I'm good at something, and we figured out a cadence of who does what. And without, some of these are also unspoken, but it just automatically has gotten to that point, to the point where now it's actually a bit scary. Like, it's almost telepathy. That, if we're sitting in a room, we actually don't need to talk to each other. We're already completing each other's sentences in our respective minds. Many times, actually, it's a bit uncanny. Many times, like when we have some external engagement for a meeting, both of us are going together, or some interview, etc. We have to coordinate in the morning that we don't end up wearing the same clothes. So it has happened, and in numerous number of times we've both shown up in pretty much identical clothes.
There's a Snapdeal uniform.
No, this is nothing. There's not a uniform. This is like, if I could be wearing like a blue shirt and black trousers, he'll show up in blue shirt and black trousers. So I think there is, this is really as I said, a great blessing. I think definitely the universe did conspire a little bit for this to happen.
Well, there's this movie called Zindagi Na Milegi Dobara, and where Hrithik Roshan, after a drunken night, says, "Ye sab likha hua hai." This almost seems like that. But tell me about this, as any company goes through ups and downs, and I'm sure like Snapdeal has its own. How was that process dealing with Rohit? Like, which were each one of you taking a motivator role? Because I'm sure that sometimes one is down, one is above. How does that work?
No, that's well said. What happens generally, Sandeep, is we've seen many situations where companies have gone through their tough periods and the founders have just not stuck together, right? At really minor crises also. What we've seen is that, like, even if there is a small fissure in a relationship where they're not communicating well enough, founders are not communicating well enough, or there's some amount of mistrust that has crept in, or one founder feels the other that I'm doing all the work and the other one's just in for the ride. Like, all types of feelings creep in sometimes, whether they have merit or not. And then whenever at the moment a crisis happens, it precipitates a complete disruption in the relationship, even if there was just a minor fissure. And hence you can never take a relationship for granted, right? You may have the best relationship. Same applies to our personal lives. You may have the best relationship with a spouse, with a parent, with a child. You can never take it for granted. You have to always feel that this is a bowl. It has this special liquid in it, but it is an open bowl. And if I don't keep replenishing it, keep taking care of it, make sure it doesn't spring a leak somewhere, make sure all the special liquid doesn't evaporate one day. If you are just mindful all the time that this is an active relationship, it requires work all the time. It requires respect, giving respect all the time. You can't take anything about it for granted. Then the fissures, even if they do happen once in a while, will get mended.
Sure.
Right? But if you just let it go, you just let it just drift, it will break, right?
Yeah.
And I think you're right. Like founders have their ups and downs, particularly during troubled times. But thankfully, at least in the case of the two of us, if I had a high day, Rohit was having a low day, I will pick him up. If I was having a low day, he was having a high day, he will pick me up. And thankfully, neither of us, there's no point where both of us had a low day. Or maybe we just auto-adjust each other accordingly.
But one of the things I think about a lot is that who gives feedback to the founder, right? So typically, there are these 360-degree feedbacks where the team gives feedback to the founder, but honestly, it's sometimes not as unfiltered as it should be, right?
Yeah.
And even when it comes to the board, it happens only in a certain cadence.
And people are always trying to be polite.
Exactly. And therefore, it's true feedback can only come from the co-founder. So have there been times when Rohit has said that, Kunal, this you should have or could have handled it better, and vice versa?
I think there's a way to say these things, right? I feel that first and foremost, every such moment where you feel you need to give feedback to your co-founder, you first have to reflect very deeply. Is it significant enough? Is it an irritant? Is it a minor thing? Or is it getting to a point where it is fairly significant that it warrants a conversation?
Sure.
And one should get to that point with some amount of deliberation. Not someone said something in one meeting and the next, literally 30 minutes later, you're like having a screaming match.
Yeah.
That's a very immature way of dealing with things.
Yeah.
So you reflect on it, sleep on it for 2-3 days, 4 days, 2 weeks, 4 weeks. It is okay. Take your time. Because each one of these conversations is a very sensitive conversation and must not be taken lightly. Because the other person is not going to take it lightly. Assuming you have a good bond and a good relationship. Then once you've decided that, okay, this is an important enough conversation to be had, then reflect deeply about how to have it, how to say it.
Got it.
Right? So that it's not a finger pointing session, but more of a, I think we could do this better. Right? We could do it differently. Or here's one way I think we can approach things.
This resonates so much. So internally, when we have to give feedback to each other within Deserve, we write it down to ourselves first. So this is the feedback. So that in a way, it's forcing me to think harder about what are the core points, and sometimes removes my emotion from the equation also.
Also, I feel that if you build enough trust, transparency, respect for each other, and you put in these deliberative cycles around thinking, should I? And if I should, then how should I? Right? Then the other person knows that you would have gone through a few of these hoops in your own head before you had this conversation. They'll also take it positively. They'll also take it in the right spirit. Right? And then if you are going to give, be ready to get also.
Absolutely.
Right? So
feedback is two ways.
It's really fun to give feedback. Nobody likes getting it. Right? But if you're giving, be ready mentally to get also. Which is okay, because you know that it will be given with the same deliberation, with the same sensitivity, same sensibility, as well, with the same intentions.
No, Kunal, this has been a fantastic conversation. I really loved how you think about making new investments, how you help companies scale over time, and also like the candidness with which you spoke about the co-founder equation. Thank you so much for doing this.
Thanks, Sandeep.